All right, so this is a question from Al. And the first question for today from Al is, do you have any ideas on how to work a runaway trade? All right. Now, he says he bought Verizon 44 calls. Okay, don't know the price yet. I don't know the expiration. And then a few days later sold 46 calls against them. So it looks like we're in a Bull Call Debit Spread if we have the same ratio. They're Januaries, okay? It's a profitable trade, but Verizon has run the 51, leaving solid 5 points on the table. Okay, I'm not really concerned that VZ will drop below 49. I can try to buy back the 40 calls and resell higher. I've done that about half, willing to chip away at the position. Okay, it's hard to do because all the positions have huge delta. All right, so no problem. What we're looking at here, let's go to the custom spread tool. Here, let me make sure that we're all seeing the same view. I apologize. Yep, up at the top here on our available strategies, this is the PowerOptions site. I'm going to click on custom spreads. We're going to build this position for Al. So we're in Verizon, and at one point we bought some, I'll just use the 19th. We bought some 44 calls, and then later on we sold some 46 calls. Okay, so this is originally a Bull Call Debit Spread. The actual prices aren't going to matter, so I'm going to make a subtle change here. We're going to say that we originally bought your 10 or so contracts. I guess you had mentioned that you did 5 at one point. You rolled up 5 or something along those lines. So we got the 44 calls, and I'm sorry, let's just put in $2, and then later, let's say we did this for 70 cents or so. So $1.30 debit on a 2-point spread. It's going to look like a high return on the position. All right. So, I'm sorry, this would help, right? I got to change that action to sell. Now we're going to see a Bull Call Debit Spread. All right, so here's a profitable Bull Call Debit Spread that Al mentioned. What's missing, of course, is the stock had a strong run up to 51.09 where it is now. Now, Al's position is profitable. He had a Bull Call Debit Spread. As we showed, we put in a net debit of $1.30. 1,300 for 10 contracts of the position. Remember, we sold the 46s and we bought the 44s. As long as the stock stays above that, we get to close out the position. We get the $2 back for the difference in strike price, so we're looking at a potentially, as I mentioned, these probably aren't the real prices, but looking at a $700 return on a $1,300 investment, 53.8%. This price is probably different. That's okay. All right, now, to Al's point is what can he do to get more? He wants to get more. So as the trade started to move up, what could he have done to do more? Now you could approach this, Al said that he did do this with half of his position or so, and he rolled up the 46s to maybe the 48s. He doesn't feel they're going to drop below 49, so he could roll up. Let's just take a look at rolling up the short option to begin with. So it's just simple, treating it almost like a covered call. We're going to add back in that we're buying the 46s for about $5.20 or so, and we're going to sell the 48s now for probably about $3.30. Okay, so we're just going to roll this up. We're going to buy the 46s, 10 contracts. We're going to sell 10 of the 48s. We're going to enter a debit to do this. Okay, let's take a look at how it breaks down. All right, so the midpoint prices, it would be $5.23 to buy back the full, and Al, I realize that you already bought back half, and you might have rolled half, and now you're sitting on the rest of it. But doing this here, you're going to pay a debit of $1.90 to gain 2 points higher payout. Now, I don't particularly like this. You mentioned the deltas are too high, and I agree with you, all right? Because you're not getting much benefit rolling 2 points up and paying a debit of $1.90. You're just getting about 10 cents extra, or for 10 contracts, $100 extra on the return. But the debit increases. Okay, so in this case, rolling up the calls can be useful, but now that your deltas are so close, your deltas are so high as you mentioned, you're paying almost intrinsic value between the rolls here. All right, so you're only getting 10 cents of benefit in this position. What would have been a 70-cent profit or $70 profit against a risk of $1.30 that we originally looked at. In this case, what's going to end up happening is you pay the $1.90, but you're not getting much more out of that. Okay? All right. Now, what are some other things we might have done? Well, what's interesting is in addition to rolling this up, once we roll the short call up, we might be able to take some of that increase in debit we just accrued, that extra $1.90 or so to put our total debit up to $3,200 by actually rolling the long call. You know, that gave you some value too. So let's take a look. What happens now if we go back into January? And I know we just closed the 46, but let's say now that we've closed our short 46 call and moved it to the 48, what if we sell this 44 call and now buy more 46s? Okay, so let's sell to close 10 of the 44s, buy another 10 of the 46s. You rolled the whole spread up. Remember, the original return was at about 53.8%, $700 off of a $1,300 investment. We've lowered that. We've cut it in half by paying the debit to roll the short call. Now let's roll the long call for a credit. You see here we're going to generate almost $1,900 back. And so now we're back to that $725 profit, but unfortunately the debit's around $2,000. Now this is an accurate depiction. The return is accurate. It's going to be $725 max return, a little bit higher than what you originally had. And now you're in a bull call debit spread, long the 46, short the 48. As long as you don't think it's going to come down to 49, you've gained about 25 cents. Okay, so instead of making $700 with the original spread, you've now increased it to 25 cents. Not the 5 points that it moved from 46 to 51, of course, Al, but you took some money off of the table. You countered the debit by doing it this way. Now, another thing I might consider at this time, well, not at this time, but might have considered as the position was moving. Let's go back to our bull call debit spread. And I'm going to move to another screen very quickly. And I'm going to go to the option chain for VZ. All right, so let me change over here. There we go. We're back at the top. And I've just put Verizon into the top. Let me go to the chain. Okay, and this is just a breakdown. Let's just go to the straight call chain. It'll be easier to view for all of us. There we go. We've got some of our premiums here for the December. We know we want to see January 19, but I want to go back 5 days. Okay, so I'm going to go back historically, and let's go back to the 4th. Let's go back to Monday. Let's just see here. At that time, Verizon, oh, it was still at 51.72. Let's go back a little bit earlier in time. Let's go back a little bit to November there. That would be a little bit better. Let's go to the end of November, last Monday of November. Let's go to the 24th. All right. Okay, so now it's at 47. Still above your 46. Probably would have done this later, but what I'm looking for here is on our original bull call debit spread, when we had sold the 46, bought the 44, if it goes up a full strike, maybe to 48 or 49, you're still comfortable with the position. Potentially rather than rolling it, maybe you could double dip. Maybe you could have added a 47-49 spread when the stock hit 50, or we could do that now. Now increases the cost in the position. You're not getting any benefit out of the profitable trade yet. This is kind of considered a ladder position. And you rolled 5, so I might only do 5 now. Okay, you rolled half of your position. I might only do this in half. So let's see here. 47.49. Prices aren't great right now. Let's see what it would have looked like when the stock was trading at about 50. Let's go back to December 1. Okay, so it's at 51.25. And the January 49s were at 214. Weird bid-ask spreads there. Oh, that's because they're the weeklies. I'm sorry, folks. Let me get to the 19th correctly. There we go. All right, that's good. 450, 278. That's what we're going to call it. We're going to call it 450 and 278. So I could have done another bull call debit. Up this one at 450, Sold this one at 278. Let me adjust that. Do 5 and 5. It's going to look like a strange ratio spread. But now I'm still trying to get advantage of this other 2 points. My debit, of course, would have been about $1.42 just for this trade, but I can still get another 67 cents, so it would have gone up to $8.40. That's a strange profit and loss chart, but you've kind of laddered it up. Okay, so that's another idea. I see investors who trade long calls will do this occasionally. When the stock continues to move up, they might buy more calls on the position and continue to go as well. So if you had originally just bought the 44 call, the stock went to 47, they might have bought a few more 46s, and then it went up to 49, you might have bought some 48s. They ladder the calls up, and eventually they might start selling the lower one if the delta gets close to 1. But you can also ladder a bull call debit spread, and this would have increased your profit by another potential $140. You're not taking advantage of that full 5 points, because remember, anytime you've got a spread, we've got that short option obligation there that could cause you to cap the upside. It's really hard to play catch up to a move such as 5 points and so forth as well. Okay, now what's the downside of this? Downside is the risk. Okay, by doing this higher spread, of course, adding to a higher spread, laddering spreads, instead of having that original $1,300 invested, you now have got $2,160 as a debit. If the stock retraces and suddenly falls down below 44, I'm not expecting it to, but if something changes in the next week and we see it drop 2 points over the next 4 days, you've increased the maximum loss on the position. The conservative approach, Al, here, is if at this time you're in that position, and Al came back in and said yesterday, for example, he bought back half of the 46s on a dip, and today he sold 51 calls on a ramp. Well, you might be a little bit too close to at the money. And you placed, you sold 50.5 calls, replaced the 46 with a 55 to get some of the volume and volatility in there, okay? Yeah, the stock ran 7 to 8 points in a hurry, so he was hard to catch up to it, and that happens to a lot of us. You know, you may see a gap in his position not related to earnings where it just suddenly moves. Now you're in the position. Now, here's a rule of thumb Ernie and I have for naked puts, covered calls, credit spreads, debit spreads, any position where you have a max calculated return. When this stock started to run, and you still have the position out to 19th of January, I'm assuming. You said January. I don't know if you're doing a weekly on the 12th, for example, or the 5th, but I'm assuming the 19th. If at any time, 80-20 rule, if at any time I can close this position early, especially almost 35 or 40 days early, and receive 80% of the max profit I expected to make. So right now, instead of getting $2 back on the original spread, we saw we could almost get $1.85 or $1.90 by liquidating today, because the deltas are so deep in the money. Both these options are close to intrinsic. Well, I might take that off the table and just close this spread to get the maximum 80-85% return a month early for the trade. Still probably meeting my trading goals. And if you still like Verizon, rather than just close it, rather than roll half of the legs to a higher strike, or roll just the short leg and leave the longs open, which increases the debit and runs the risk, you may just consider rolling this whole spread out. Similar to what we did, but just close out, roll this option, roll the 44 up to, say, the 47, and roll this 46 up to the 49. Okay? Keeping a 2-point spread, usually a good idea. Keep that debit around the 2-point spread, but you're retaining 80 to 85% of what you expected to make on the original position. Okay, so that's an approach I might take as well. Looks, someone had a comment in here. Sorry, folks, just give me a second. Okay, it looks like it was a... Okay, Arvind was there. See, I thought someone had made a comment on this particular position. Oh, there it is. I think it was Rajiv. There he is. Okay. So Rajiv says, what if you roll to near the stock price around 48 and 50 instead of 46 and 48? Sure. Okay, he was just commenting on the roll that I mentioned, just going up to the 48 and 46. But let's take a look right now just with the original prices of this debit of 130, which was a bit high. It'd probably be closer to 150. So let's do a 50-cent debit, 33% return on this debit spread originally. With 10 contracts, input of $1,500 on our debit spread to make 50 cents. And Rajiv saying you could probably do better if you roll to the 48 and 50. Well, let's take a look. You know, it's always good to see that. So we're going to close. I'm going to add these two back in. We're going to close the 44 and the 46. I was saying 47, 49. Rajiv's considering the 48 and the 50. Now, the reason I didn't touch the 50 originally in the analysis, Rajiv, is Al's comment was that he doesn't feel it's going to pull back below 49, which means that somewhere in his thought and his research and analysis, he thinks it may have a potential to roll back to $49. So that's why I was hesitating on the 50. But let's close out our spread and roll it in one fell swoop. So we've got to do the opposite. Remember, we originally bought the 44 call. We sold the 46. So I got to sell to close that 44, and we're going to buy to close the 46 as we did before. At the same time, we're now going to buy 10 contracts of the 48. We're going to sell 10 of the 50. We're working on a different profit and loss. I probably should have kept it for simplicity, but now we're looking at an original position that was making $500 off of a $1,500 debit for 33.3% return. Now we've got our new numbers in place. As we mentioned, it's going to be about $1.90 to close the spread, about $1.90 debit, pretty much close to the $2 we would have expected to make on the position max, or to get back max with assignment. And we're going to generate, we're going to get another debit, it looks like, of about $1.70. Okay, so we're going to buy this at $3.33, sell this at $1.68. So this does increase the return by almost 50%, mathematically, doesn't it? We went from an expected profit of $500 off of $1,500 investment to now $775, $225 more. It's not quite 50% above the 500, but close. And of course, the debit into the position will be around $12.25. Okay, so that return's looking a little different. Why is it showing this? Because it's reading we have an extra short put. This isn't reading that I'm actually closing these options. It's literally reading that I have 3 short options open and 3 long options open, so it's counting the margin between each 2-point spread. Okay? Yeah, so that's what we're kind of looking at here, but you would increase the return. But again, the only reason why I didn't go to the 50 at first, Rajiv, and this looks like a profitable position if it stays above 50, was because that in that case. Okay? All right. So this one I think would be worth it unless the stock pulls back below 50, because it would have taken what we originally showed, that original $500 profit off of a $1,500 investment. It would have given you an extra $225 to a max profit of $775 on that new debit spread. Okay? And yeah, once they run away, they're hard to fix. It's just like, you're right, Al. And I don't have a magic repair for you. And one thing I typically don't do that you may see on several other webinars, a lot of investors, a lot of options educators out there will discuss repairing a credit spread that goes against you, or debit spread that goes against you, by converting it into a iron butterfly, a diagonal butterfly, a diagonal condor, or a condor. So you're adding 2 or 3 more legs to create a 4 or 5 leg position. I fear that overcomplicates things, and that can actually increase the risk if the stock recovers and goes the opposite direction of what you're trying to repair. So I'm usually hesitant to go into 5-leg spreads, 6-leg spreads to repair an original 2-leg spread position. I'd rather see just the management. Now, you're in a good position. You've got a good profit. How can you get more? Well, you can see that you can roll up to it. In this case, from what we originally started at, would have added $225 to your original expected profit of $500. That's a good almost 50% increase in return. But just as if I'd bought the stock at 46 and sold the 46 call, and the stock ran up to 51, which is, again, great position to be in. We should all be there. But when your covered call suddenly goes against you as well, you say, oh, well, I want to roll up. Well, the stock's moved 5 points, over 10% from when I originally bought in at 46. I'm not going to get 5 points back from rolling the call, even including the intrinsic value. because I'm going to have to pay $5 or $6 to close that leg. So I might only increase my return by 1% or 2% instead of the 10% I'm seeing on the stock. That's kind of the problems with the short calls in a spread, a calendar spread, or a covered call. They really do cap your gains. You say, oh, I missed this one. I wanted to get closer to that. I want to get closer to 5 or 6% on this covered call, then I'm only making 2% on because the stock moved up 10%. It's harder to play catch up. Okay, it's really harder to play catch up in that case. Okay. Rajiv said, yeah, diagonal calls might be good for earnings coming up as well. The earnings are on January 18th. Okay. So Rajiv says you can sell 55 calls to the week before and buy the 52.5s for January 18th to take advantage of Vega and earnings. So he's looking at sort of an out-of-the-money risk, I'll say risky myself, but out-of-the-money bull call debit spread right now, buying the out-of-the-money 52.5 and selling the 55 for a very cheap price for play of earnings coming up before the January expiration. I'm hesitant to suggest that. I'll show you what it looks like here, and then got to move on to our other questions, excuse me. But I'm hesitant to do that. I'm sorry, no, you said 52.5, 55. Deep out of the money, bull call spread. Let me get that 50 out of there. So I'd buy the 52.5 and sell the 55s. Debit of 35.50 for a potential profit of 214. Okay, low debit, that looks great. High return, that looks great. Low probability. The only reason why I say I'm hesitant to do something like this at this point, let me go to our stock research page here. Let's verify what we're looking at. Oh, it's the 23rd. I show actually the earnings on the 23rd, Rajiv, so I'd have to go out to the weeklies on the 26th in order to do any kind of spread, not stay here on the 19th, from what I'm seeing. The reason why I'm hesitant to mention this, let's say the earnings did come out on the 10th, and we were looking at the 19th, or it came out on the 15th, so we were looking at the 19th. We've got a really low cost debit spread with a really high potential return here if the stock moves up. Why I'm hesitant to say this position now, even though it has a very low debit and high potential reward with low probability, is we're talking about January 15th, January 19th, in this case we saw January 23rd. A lot can happen between now and January 23rd. If I enter the spread, sure, it's low risk, but if Verizon does pull back and drops back to 47 or 46 by the end of December, beginning of January, I'd want to look at a cheaper spread at that time, maybe to do that. With those lower strikes, maybe the 48 and 50 with the stock trading at 47, rather than put this here, because if it goes down there, both these options are going to go worthless. I can leave it open, but now at earnings with a stock at 46, the stock might only go to 48 or 49 instead of going from 51 to 55. So this would still be out of the money and I'd still lose on it. So I'd probably wait till closer to earnings rather than giving that time, okay? And Al, that's another point that I agree with too. In this case, doing this deep out of the money, Rajiv, we talk all the time about position sizing, and I know that if you entered this position and looked at it for earnings, that you wouldn't do a large number of contracts, even though it's a low debit, that you enforce proper position sizing. But Hal's comment is that now you're doing a deep out of the money spread on a stodgy stock that's had a run up, and it's more potential that it might pull back and move down. And I agree with that. I think this is too aggressive for my taste. Price looks great. Potential return looks great. We know the theoretical probability would be extremely low. Risk reward, again, low cost, playing an earnings play. But after this long run, does Verizon need to take a breath? Is it going to more likely to pull back in the next couple of weeks or continue to move up? You know, be interesting to see. I'm not going to make any projections on that. I'm just saying that I typically don't like to do deep out of the money debit spreads planning on a large move, just the same way I don't like doing in the money credit spreads planning on a big move. Even though the return is higher as well, that wouldn't work. All right, let me go back now. That's going to cover our topic on the management techniques there to the upside of the bull call debit spread. You could ladder it earlier on if you caught it. You could roll it up as we saw. But for now, we could have taken the 80% off and then entered another trade. But if you're worried about the pullback, I think you've done something right. you had mentioned you rolled to the 50.5 strikes with a stock around 51. Might have gone a little bit too high, time will tell. Okay, it's a little bit too close to at the money. The stock has been strong. We'll wait to see what it does next week. All right. All right, so Johnny says, sorry, my memory is bad, but are tools on your server, do I need to download them on my computer? Okay, so the Power Options tools we're looking at, we just looked at the custom spread. When you go into any strategy, of course, you can do a search, plugging in your criteria. I'm just going to go to Bull Put Credit. And when the search comes up, you can just put in your specific criteria of what you'd want to see for the positions. You can use our defaults as a stepping stone, but you have the availability here. Now, to answer your question directly, Johnny, all of the tools and Power Options are on our servers. You do not need to download a program to interact with it, so you don't need specific types of Mac OS requirements, Windows 10 requirements, and so forth. It's on our servers. You can interact with it with your account log on and ID as long as you have a browser and internet access. Okay, so all of your information that you save strictly on our portfolios on our servers as well also. Okay, so yeah, don't need any kind of program. We don't send you a disk. You don't have to buy a disk and an additional data service. Everything is done from our servers directly to your browser. All right. All right, Don says, can you add IV Percentile to your scans? Well, we show what we feel is important in IV Percentile. We already have it. Okay. If you want to send me an email later on to support@powerop.com, Don, talking about what you would like to see as far as your definition of IV Percentile, that's fine. But in most option strategies, single option strategies, and the spreads, we show the percent implied volatility range. Okay? What this is this is the percentage of where the option that you're researching, the option you're planning on trading, the option that matches your other criteria, where is the implied volatility of that option right now compared to where it has been over the life of the option? We prefer to look at it this way because, of course, over, if I look at a weekly option, it may have only been released in the market for 2 to 3 weeks. Really, it's 6 weeks, actually, I'll be honest with you. Okay, so 6 weeks or so, it's only been out on the market. I don't really want to compare the December 29th, I'm sorry, not December 29th. No, I'm correct. The December 29th weekly option where its implied volatility is now compared to where options on this stock, all options on that particular stock, average implied volatility has been over the last 12 months. That to me is irrelevant. And a lot of these stocks, we just talked about, you could talk about Verizon, GE went the other way, of course, but a lot of current stocks right now are up 20, 30, 40% from where they were 8, 10 months ago, 11 months ago. The volatility was a completely different story. What I'm more focused on is where's the implied volatility range of this particular option I'm researching compared to where it has been over the life of the option. And that's what our percent implied volatility range shows you. Now, again, you can email me later with your comments on what you feel is what your definition of an IV range is, or IV percentile, and how you'd like to see it presented. I'm sorry, Don, and I'll see what I can do about getting that added. But in our opinion, with all the different ones we've looked at, we feel that our percent implied volatility range that we show is more important. How do you use it? Typically, when I'm selling an option, I may want to look for an implied volatility range that's in the upper, let's say, 60 or 70 percentile, where the option's implied volatility now is near the high of where it has been, because my hope is if it reverts back to the norm while I'm in the trade, I may get that implied volatility crush, may be able to buy it back cheaper if I have to roll it for another needs. And of course, when I'm buying an option, maybe just speculating with the market movement, maybe part of a diagonal spread, I probably want to see an implied volatility range in the lower 50th percentile, or maybe even the lowest 40th percentile, so that if it moves back up and the implied volatility increases, I get an extra boost to where I originally started on my implied volatility range for my option. It goes back to the norm, it goes back up, or the implied volatility increases, I get a better premium out of it. So we show the percent implied volatility range. Now, let me take Micron very quickly. I'm just going to go to the standard option chain from Micron. And I'm going to talk briefly. Am I on puts? I'm sorry, yeah, I'm on puts. We're going to look at the December 15th. It's a weekly series. No, we're not going to look at the December 15th. My apologies. Let's go to the December 22nd. Then I'll come back to the 15th. So the December 22nd series, 43, 42 strike put now. This is a put, so it's out of the money, priced at 157 to 174. Now I'm going to go to that research tool again for the put. It's going to show us a lot of data. But I want to show two things here on our research tool for you that you can delve deeper into these sort of researches and analysis, okay? All right. There we go. Okay. I'm going to go over to the far right here. And this is a pretty good example. This first example here we were looking at, the percent implied volatility range is at 82%. Because the current implied volatility is 0.6683. In the total implied volatility range over the life of this option is 0.43, 0.4260 to 0.72. Okay, so we're in the upper 82 percentile of this position. Now I scroll down to the bottom, and on the research page that I linked to from the search or from the option chain, this shows you the history of the option. So it's a graph here. We're seeing the option bid price compared to implied volatility. You can compare it versus delta, open interest, stock price, more. All right? But if I scroll this bar back, I click on this gray bar here and I scroll it back, this is now showing me over the total life of the option from 11/2 to current. Okay? So that's sort of that 6-week cycle I talked about. So 11/2 to 11/9 is 1, 16th is 2, 23rd would be 3, here we are at 4, and then a 5 right about here, and then of course the 6th week would be to its expiration date. So it's only been out for about 6 or 7 there as well, okay? All right, now, just see something here. All right, so I'm going to, let's see, I want to leave it as is for the moment. Let's see if that changes. I'm going to change something here see if this forces an update. Nope, it's not going to do it. Okay. Yeah, I apologize. This a question just really quick came in from John. John says, why does the site only take up half my screen? Is there a way to see it full screen? You should check the settings there. That you have either on the GoToMeeting browser or more. I've got it shown as full screen right now. So it should be coming through at full screen. I don't know how I can increase the size there for your view. I've tried to force it twice, but I think I'm already at full screen. So you might want to check there, John, on your settings, see if you can do that. Now, why all this discussion about the percent implied volatility range other than is what was asked for? I wanted to show you that here in the research tool, you can see the range itself. You can also select to see it on the search tool, and that's important. The reason why it's important is that this one's in the 82nd percentile of its total IV range. But if I see an implied volatility range here at 0.6683, and the percent IV range is at 82%, but the total range is, let's say the implied volatility right now is actually at 0.71. The real implied volatility, current implied volatility is at 0.710, and the actual range is only 0.68 to 0.72. Well, although it's in its 82nd percentile, this doesn't show me a lot of movement in implied volatility. It's keeping standard implied volatility since it's been released, and it doesn't have a lot of swing. This one has a fair amount of swing, which you might be able to use to your advantage. Of course, we all know we selected MU, which tends to move more frequently. Now, let's go back to the chain very quickly, folks. And let me grab standard December expiration. So we went to the weeklies. We know the weeklies are only available for about 6 weeks. I kind of want to focus on what is the implied volatility of that option since it's been released on the market. If I go to standard expiration for December 15th on MU, now got the 42.5 strike. We'll go to the put research there. This will show us the implied volatility range right now. We're at the 36th percentile because it's at 0.4838, and it's only been from 0.39 to 0.6505. All right? But now I scroll down to the bottom. again, let's take a look at our graph. Now did that link to the right one? That should be much more. The December 15th series should have been, I know why, I apologize. My fault entirely. Let me take just the 40. I'll do the 39. That particular option hasn't been out as long as I thought it should have been. This one might not be either. It's kind of interesting. There we go. So since September, see, because it's a standard expiration, it's not a weekly, this option has been out since September. Okay, and yes, I can see the total implied volatility range here. You see how it's moved, but it's stayed pretty average, not really going too far out of bounds. But that's why it's more important to me is where is the option's implied volatility now over the life of the actual option, as opposed to looking at all of the options surrounding it for the past 12, 15 months as well. That's what I tend to look at. Okay, all right. Okay. Let's move on now. So that's my thought on the percent implied volatility range. You will see it on some of the spread strategies. You'll see it on the single option strategies, covered calls, naked puts, long calls, long puts, and so forth. And we can typically add it to a search if you're trying to use a search in a given strategy and you don't see the percent implied volatility range there of that particular position. All right. Okay, Arvind asked a question regarding early assignment. He says, please let me know that I got assigned on Snapstock at 1250, but the market was 1430. So what could I have done in this case? So what I'm assuming Arvind is asking is that he was on, the stock's at 1507. I think he's saying that he sold a 1250 put. Now, actually, if you sold a 1250 call and you were assigned, that makes perfect sense. The market value is 1430. I think you're asking, you were assigned on a 1250 short put that would have been out of the money with the market at 1430. Okay. Well, at one time it was, I don't know if it ever did. Let me go 1 month. I apologize, folks. We're going to go to the profit and loss chart here. I'm going to go to 1 month. There we go. Yeah, see, a couple times it broke below 1250 here. That's just enough. Okay. Now, the only time it was at 1430 was, it hit up here. So yeah, I don't know what to tell you. If you had sold a put here and you were assigned here when it gapped up to 1430, I'd say that doesn't make sense. You can probably get some more information for your broker. But remember, investors can do that at any time. Okay. But I think you're right. They wouldn't have signed that there. If you had a covered call, of course, or a short call, and the stock was here, of course, you can be assigned early. You could be assigned early at any time, whether it was because of earnings or I don't think it was a dividend. But you can see here the stock's fluctuated, and it might have been a dip here. It was still above 13, but in a panic, you might have been assigned at the 1250. I don't know. So it depends on the day, Arvind. It depends what was coming up before then. But you're right. If you get assigned early for any reason, there's nothing you can do about that. Whenever you sell an option, remember you can be assigned at any time. Shouldn't happen unless you're in the money. So I'd like to see some more information on you from that. When did you get assigned? What date? Around what time? And as in addition to that, what was, I'd look myself, but what was coming up at that time? And I'm sorry, my other thing is, did you have any other positions open? This is just a short put at 1250. Did you have a short stock? Was it part of a covered put position, for example? Something along those lines as well. It's something that could have been done. Larry makes a comment. Larry says, may I share an option strategy that has generated about 8% per week for almost 3 years? Yeah, you can type that in and send it to us. I'm sorry, Larry, I just got to it. We've had the other questions there. If you want to write in what you're doing, I can share it with the rest of the audience. And we can take a look at it there. But sure, yeah, you can share that as well. Good job, by the way. All right. Okay, I'm going through this real quick. It looks like Chris has a bear call on GE. Okay, and he wants to know if he should close it now or wait till, I'm sorry, Chris wants to know if it should be closed now or wait till next Friday. Well, this is going to go down to the 80-20 rule in a different way. Okay, so earlier we talked about a bull call debit spread that's in the money. And, hold on one second, there we go. And we talked about ways you could manage it to maybe try to get a higher return, Chris. Now we're talking about the exact opposite. All right, so it's for next week expiration. 23.25. I'm going to say you got 15, 20, let's do 20 cents. So at some point, you entered a bear call credit spread, and we're going to say you sold this for 40 and bought this for 20, 23.25 spread. Okay, on the position, so a max of 11% return. Okay. So this is similar to what I discussed before with the 80-20 rule. Depending on what credit you have, how many contracts you have, if you've made 80% of what you expected to make or more, why not close the position early? But again, unless some major news comes out, and we saw the major news today, right? Was it 12,000 employees they're going to let go? Something along those lines? There's two different companies that were releasing 12,000 and 15,000 employees. Tiva was one of them. General Electric was one of them. So I think we've seen pretty much about as much negative news as we can on this. I'm not saying it's going to go back up to 23 next week by any stretch of the imagination. So now it kind of comes down to you. As a general rule, if I can close a position, a credit spread, a debit spread, close it 10, 15, 20 days early and make 80 to 85% of what I expected to make on the position, I'll take that off the table. 5 days left, you can't close it today, so you can close it on Monday, but with 5 days left, you're 6 points out of the money, almost 45%. Now, okay, not 45, 38, 39% out of the money. You've got a 2-point margin covering this position right now tied up in your account. That's it. You could get full profit. I can't give you direct trading advice, but I can say that, you know, barring some kind of major news event in the next 5 days, I don't think this will come back up to 23. We'll have to panic. Remember, it can always happen. That's always the key. It can always happen. But as a general rule, credit spreads, debit spreads, even cash secured naked puts or covered calls, if I see an 80% return, 80% of what I expected to make on the position, 10 days, 15 days, 20 days early, I'm likely going to close the position. Okay. I sold a call for $1. I can buy it back now for 15 or 20 cents, and it still has 3 weeks to expiration. I'm probably closing it. Same with this spread here. Now it's 5 days away, of course. We didn't close it today, so I'm going to say there might not be as much risk or as much harm or as much headline risk of this stock bouncing back up to 23 over the next week. But remember, it can happen. So I don't see any harm in leaving it open, but it can happen that it could go back up to 23. I don't know what event would have to occur to cause that to happen. You're looking good on the bear call spread now. You could close it early on Monday or on Tuesday, free up this margin requirement for new trades, maybe going out to December 29th or for January expiration on your bear call spreads, or if you transferred over to bull put spreads, depending on your sentiment of the market itself. Okay, but either way, this is a good approach, I think, in this case. All right, in this case here. But you could probably close it and get 80% of what you expected to make on the position. Let's just take a look with the midpoints here. 0 to 1 on the 23, 0 to 1 on the 25. So yeah, you're going to pay a commission to get nothing back, essentially. It's probably going to be 1 cent and 0.005 cents, half a cent and maybe 1 cent to close this position. Is it worth the commission cost at that point? Again, that depends on what your original net credit was and how many contracts you did and what are your commission fees. Okay, so don't have one answer for you. I think either approach is pretty good. You could close it early, take the money off the table, free up the margin, or I'm assuming you could wait until Friday, and I don't think you'd have any issues there with a stock at 17 and the 23 strike. Okay. All right, Robert, bringing up the old gems. Robert B. All right, when watching the archive seminars on the various strategies, specifically the Iron Condor positions, which may be several years old, can we be confident that the strategic information and tools presented are still current and accurate? Is the strategic information still accurate? Absolutely. You notice what we don't do in those webinars when we discuss strategy is really show you what you should expect to make or make promises of returns. We show you what we look for conservatively to get the right risk-reward ratio and success rate that we'd need on a bull put credit spread, bear call credit spread, or an Iron Condor to be successful long-term, which, by the way, even if you're looking for bull puts or bear calls with a 75 or 80% probability, you're going to need to be right 85% of the time to profit long-term. That always still holds true. Are the range out of the monies, probability discussion we talk about in those Iron Condor strategies, are those still accurate? Absolutely. If I was opening an Iron Condor today, I would still follow those rules of thumb that we talk about for the percent probability between, range out of the money, time frame for the spread. Now there is where slightly is a hiccup, because those presentations are old enough where there were some weekly options on SPX and the 10 or 12 major stocks that first started releasing weekly options, but those were done at a time when there weren't 480 to 490 securities that offered weekly options, and 490 securities that offer weekly options where you have weekly expirations 6 cycles out in a row at any given time, including or not including standard expirations that already existed. Okay? Now, why don't you see more information on a regular basis from Power Options in our options strategy section related to Iron Condors or Iron Butterflies? One, I am not a fan of Iron Butterflies. And you take a look at an Iron Butterfly position where you're, let me just go ahead and add Iron Condor and Iron Butterfly in here real quick for us. With an Iron Butterfly, it's very similar to an Iron Condor. You're doing 2 credit spreads, but the 2 short options are at the same strike price. So if this stock was at 100, you know, most popular stock ever, XYZ, stock XYZ is at 100, I might be selling the 100 call and the 100 put, buying, let's say, a 105 call, that would be my bear spread. Buying a 95 put, that would be my bull put. So I'm trying to pinpoint a strike price where I think the stock will be trading in the next 7 days, 12 days, 14, 15, 30 days, or within plus or minus 0.5% of $100 in the next 14 or 7 days. If you go 30 days out, maybe 1% plus or minus from 100, so that you're still in that upper to lower break-even range. If you can pick a strike price over a 20 or 30-day period within plus or minus 1 or 0.5%, and by consistent, I mean close to 70 to 75% of the time, you'll be good at this strategy and you don't need my help for anything. You're going to be much more successful than I am long-term. Okay? Because I can't do that. So I deal, if I think the market is correct, I deal with Iron Condors. All right? Combination of an out-of-the-money bull put credit spread, bear call credit spread, so we have a lower max return compared to the Iron Butterfly in the same stock, but we have a wider upper to lower break even, better probability of success long term. Now, all of that being said, Robert, the reason why you don't see more education from me personally, since I handle the education at Power Options and more, the reason why you don't see more education on the Iron Condors, and you've heard me maybe mention this, I hope, in some, I've mentioned it in the spread series that we did that's archived. I've mentioned it in some of the other discussions we've had on Fridays where we talk about bear call spreads. I have not done an Iron Condor in probably 3 to 4 years. I'm sorry, it's more about, it's about 2.5 to 3 years. I have not done an Iron Condor. Why? Even before the last 30 months or so, we sort of just saw the market do this in general, lower left to upper right, in general, last 28 to 30 months. I was seeing Ernie's positions and some of my Iron Condors just getting consistently hit on the bear call side. I'd set it up even, so where if the stock was 100, I might be going 10 points out of the money on a $100 or $2 stock and 10 points out of the money here. I have it set up so it's even. I don't put a bullish or bearish bias on my Iron Condors, okay? But these were getting violated. The bear calls were getting violated. So you say, oh, well, why don't you just do an Iron Condor, but make it so that if the stock price is here, this is 20 points out of the money on the call side, and this is 10 points. And I'd say, why complicate it? If the market is doing this and that's still my sentiment, I'm just going to do the bull put side or the bull call debit. Not even going to mess around with trying to get an Iron Condor for the extra premium where this side keeps getting violated. I'm going to stick with the sentiment. And that's what we've been essentially doing for the past 2.5 years. There are times when we think the market's changed based on our market sentiment tool where we see the opportunity to do a bearish spread on, say, SPX, NDX, or others. But in general, we've just decided to go, both Ernie and I, because we are sick of seeing positions get stopped out, we've been going directional, just the bull side or just the bear side. You say, oh, well, you're making less money by not doing the Iron Condor. When we look back historically, we were making more money than we would have by not doing the Iron Condor because more positions than not would have had to have been stopped out on the bear call side, rolled for a loss, or managed for a loss, and then tried to continue to manage long term, whereas just doing the bull puts was a success rate of about 91, 92%. Can't beat that, why fight it? Okay, until the market changes and our sentiment changes, we're just sticking with one side or the other for right now. That's why you don't see a lot of education on Iron Condors. That's why I've mentioned it in my other webinars, is that right now, with volatility, and the term I'm enjoying right now that sounds very silly, but headline risk, I don't think the Iron Condors, even with going 30 days out, 10% out of the money on the short put and the short call. So if the stock's here, I'm 10% out of the money on both sides and have maybe a 80, 82% probability. With the headline risk, geopolitical risk, and everything else that's out in the market today, little shifts causing a lot of change and volatility, I don't think it's the environment for Iron Condors or Iron Butterflies. And you already heard me describe why I don't touch Iron Butterflies right now. Too much risk for me, and I'm not good at pinpointing a strike price. So I don't mess around with it. Even though the return is potentially higher on an Iron Butterfly on the same stock, that's very exaggerated, but the upper to lower break-evens are closer. So, we're thinking NASDAQ was looking strong 2 weeks ago. It's a good opportunity for an Iron Condor, so we got in, let's say, with an Iron Condor in NASDAQ 2 weeks ago. What happened at the end of 10 days after we were into that position? NASDAQ was trading over here. Right? It dropped significantly. It dropped to where a profitable Iron Condor would have been violated on the bull put side. Okay, with the market just continuing to do this, you would have to put a bullish basis on your spread where your bear call side of your Iron Condor or Butterfly might have to be further out of the money to get that higher success rate. So you sort of got a, lack of a better term, lopsided Iron Condor or a bullish bias where your bull put's close, your bear call is really far out of the money and maybe only giving you 8 to 10 cents. Why bother with it? Just do the directional. Of course, everyone has their own sentiment. If you think it's more neutral, most of what you see in that Iron Condor discussion there, the Iron Condor presentation, is exactly how I'd approach it today. I'd make some changes to that Iron Condor presentation based on the increase of securities available that have weekly options, okay? Because I'd have to adjust my criteria, my range out of the money. Okay, I'd have to adjust my criteria, meaning the range out of the money, minimum net credit, and so forth based on it being only 5 to 10 days out as opposed to standard 20 to 30 days out in time, is what I mean by that. Okay, so I'd have to change some of those settings for reasonable expectation. And I'm not a fan of doing a bullish or bearish bias on my Iron Condors, making them lopsided. I like them to be even ranges to the short options, nice and level one. And yeah, I just don't trade them. I've been staying with bull puts or bear calls, not trying to do both and risk getting one side stopped out. So that's why you don't see the education from us right now on Iron Condors, because Ernie and I feel it's not the best market conditions for a Condor strategy. All right. Okay, looks like we've got a specific strategy session, a strategy question here, a specific trade question. Let's see, Rajiv. I sold in the money put on AKS after earnings, 5 strike for December. Okay. Let's go back to the custom spread tool. Let's take a look here on AKS. All right, so we sold December standard expiration, I think, yes. In the money put for AKS. 5 put at 55 cents, now become 4, okay. And close the position. Tried to roll it for the January 18, 550, not getting premium more than 44 cents. So lower. Okay, so you sold, let's just do this here. You sold it for 44. So what Rajiv is saying, he's having a hard time closing his positions and getting reasonable premium. Oh, 55 cents, my apologies. All right, so here's your original position. Cash secured naked put or margin put for 55 cents, 5 strike at 55. And okay, so you want to try to roll to January 18 for the 5.5 strike. Okay, so you'd have to, I'm sorry, January 18. All right. The 5.5 strike. Well, I mean, it's 40. I don't understand here. Buying back the 5 for December looked like it only cost you 4 cents. Okay. It became 4 cents to close the position. Tried to roll for January 18 at 5.5, but not getting premium more than 44 cents. And that's still, no. Yeah, it's lower, but look, I don't understand the problem here. What you're saying is that you're only getting 44 cents, which is lower than this was initially. That was because volatility probably decreased, and you're going deeper in the money. You know, it's not, or less in the money, depending on what the premium is. So the stock's at 533, and we'd sell this one, and you've got to buy back your December one. What I want you to keep in mind is I know it's lower than original, but number one, it's not like you're rolling for a debit. Okay, you've got this back at 4 cents, so you still kept 51 cents of what you expected to make, and now you're taking in an additional 47 cents. So really, you're looking at 98 cents to me. I don't see that as it's less than the 55 you originally received. Market conditions were different when you sold this December 5 put. Even though it was slightly in the money, implied volatility might have been slightly higher in anticipation of earnings or the market as a whole, or when the NASDAQ was pulling down, even though this is not NASDAQ related, but you know, as the market was shifting and volatility was being increased and different than the VIX was up at one point to about 1250, 1260. It's right back down now to 920, 980. All right. So yeah, you were able to buy it back for 4 cents. You're not getting 55 cents on this one. It's at 47 cents now midpoint, but you're only getting 44. I'm considering the trade as a whole, rather than looking at this having to be the same premium as the one I originally sold. Market conditions change, and you know, this is one of the risks I always tell investors about covered calls, where, and I'm not saying this is the same situation, Rajiv, but looking at a position where, you know, a high volatility, I might be able to buy a $23 stock and sell the 23 strike for $2. No, here's a better example. I'm sorry. You get into a stock at 23, and the in-the-money 20 strike for 30 days out is priced at $6. So immediately you dropped your cost basis to 17. And you say, well, what can go wrong? Even if the stock falls to 17, well, let's say it falls to 15, I can sell the 15 strike for another 6 points, and I'll be fine. Well, the problem is if there's an event coming, which there is, which is why that 20 strike is so inflated in premium, and giving you a over 10% return on that covered call for a 30-day trade, is because some event's coming up. And if that event causes the stock to drop from 23 to 15, that means the implied volatility is going to be gone, which means that now the stock dropped to 15, you're probably selling the 1 month out 15 call for 50 cents, not $3, not $6. It's probably worth 50 cents now. So managing it is going to take you a longer time. I don't think this is a bad position. You're trying to buy into the stock, and again, even if it stays below 550, now sure, here you would have gotten in for a cost basis of 445. You're trying to stay in the money to get put the stock, so you're doing the 550 put now, hoping to get put the stock will generate some premium. And so now instead of your cost base being at 445, it would be at 452. I do understand that. I see where you're coming from in that description. But at this point, I've got to say, if you really want to own the stock at a lower price, take the 51 cents you've already earned, buy the stock at 533, which would put your cost basis, again, to the lower price, down to about 480 instead of 440, and then sell a 5 or a 550, or a 550, in this case, covered call against it. Okay, if you're trading on margin hoping to put the stock and lower the cost basis, okay, but if it's not giving you the price you want because of the roll in the adjustment, and you want to get a lower price into the position here, hoping to get put the stock, I might suggest just buying the stock if that's your end game right now and selling the 550 call. After this happens, after this cycle, it's just that's where my thoughts are there. Okay. Yeah, and John D says, yeah, as you mentioned before in our previous discussion, that's why I only do bull put spreads on the SPX, okay? All right, so that's there. All right, let's try to go through this. So Rajiv, I understand what you're saying a little bit better now. You're staying in the money, hoping to get put the stock, and what you're saying now is that because you had to raise the strike by 50 cents, you're not getting the cost basis if you're put the stock that you originally wanted. Right? You're getting 98 cents against 550, so it's close. Here it would have been about 445. So you sort of increased what your new cost would be. Again, if your end game is to get the stock at a lower price by using the in-the-money puts, at this point, you might just want to buy the stock and convert it to a covered call. I know you're probably going to get 20 cents for that 550 call, so it would still lower the cost basis only down not too much there, but that's what I'm looking at. All right, so let's see here. Okay. Yeah, Rajiv says it's still a bullish view. Yeah, just anytime you're analyzing a strategy, and I don't think this is a bad trade that you did here. I kind of like it. I don't mind the adjustment if your end game is to buy the stock. I think you're still in a good position. But remember, if your end game is to do X with options, whether to own stock, to not own stock, however you're looking at it, what you want to do, if you didn't like, for whatever reason, Rajiv, when you're running this analysis and you did not like what you saw with rolling to the next higher strike put, that it wasn't giving you the cost basis you'd want, before you sold that put, I would have looked at the parity trade, and I would have looked at taking in the 51 cents I made already on the first short call. So this would be at 533, and we'd reduce that. If I bought the stock right now, it'd be at 533. But we're going to reduce that by 51 cents. So we'd be at 482 would be your cost basis. Higher than what you get now if you were put at 550, it looks like. And then for January, where you were looking where you rolled, if I sold the 550 call for, we'll call it 30 cents even, I mean, it's still the same monetary return, isn't it? Yeah, still the same monetary return. You've got your cost down to 452, not the 445 you're originally hoping for, but it's about the same trade. And you're already in the stock already if there's any other advantage to owning this stock, such as a dividend or so forth. Okay? All right. So always compare it to the parity trade before jumping in if you didn't like what you saw originally. That first one you didn't like, that first roll didn't match what your goals were. You didn't like it, as you mentioned, because you wanted it to be a little bit better. I compare it immediately to the parity trade. See what it would look like there. What would the covered call return be? And we see that the moneyness of both is even. It's 98 cents. That's the max profit in both situations. With your 550 put that you rolled to that's slightly in the money, or buying the stock right now, factoring in the gain you had from the stock, the original naked put trade, and then doing the out-of-the-money 550 strike call. In this case, the moneyness is dead even. The max return in both situations is dead even at $98. The difference is that on the naked put, if the stock keeps going up, well, the put expires. That's good. You could sell a higher in-the-money strike going forward, but on the covered call, you'd get assigned, potentially be out of the position without putting more money in. All right, now to counter every discussion I just had, not every discussion, but to counter to counter the discussion I made on Iron Condors and why I have not been trading them for 2.5 years, and what John D said to me, Larry had commented earlier on that he wanted to send me his trading ideas that was extremely successful. And so here's his trading idea. And it goes counter to exactly what I said I wasn't doing. So someone's making it work, it's just not me. Larry says for the past 155 weeks he has used one strategy. He's done Iron Condors just on SPX, RUT, and occasionally NDX. Iron Condors, broad-based indexes. He only uses weeklies. Of 155 weeks, he'd only had one losing trade, and that was because he went against his own discipline. Okay. All right. So using this strategy, I'm not going to say numbers here because technically by law I can't do that. Okay. As far as moneyness, but this is his trade. So he says he's generating about $80 and now getting about $1,000 per week using $10,000. Okay. He's just all documented. Okay. Let's see, he started to doubt himself and watch others. So many experts out there. Okay. Now, what he's saying is that it works for him. His updated spreadsheet thinks it's possible to get around 9% per week. Okay, 9% per week. And that's what he's been doing. Let's see. There's about 5 comments in a row here on this. So let me just bear with me, folks, the way that the tool allows me to read it. He says most of the time he's been using SPX. And then because volatility had been so low, he started using the Russell and occasionally the NDX. And as I mentioned, you know, weekly NDX last week would have been dangerous. Using alerts and contingent orders on the positions. And NDX makes you nervous, I understand. Yeah, that last week it really got me, especially with, AMAT. I'm sorry, Larry. AMAT's the position I'm in. We talked about it in the last 10 days after its earnings. It went up to 61 from 58. Since then, it's dropped down as low as $49. Came back up to 52.50 yesterday and dropped back down to, where did I end up today? 51.05? That's the last I saw. No, 51.43. Okay, so it's been, just take a look at that chart again for AMAT. This was one of the NASDAQ stocks that's just had a fun 10 days. Oh, no, I just want to go 1 month. Here we go. There you go. So yeah, after the earnings here where it broke above 60, 61, thought it was going to have a really good straddle. Opened it close to 61, and then by the end of the day, yeah, it was right back to where it started, below where it started the day before. Kind of came up, got excited. This was a married put, so I rolled my put up here, sold a call, and then flop, flop, almost hit 48. Came back up to almost 54, then dropped back down to 52, closed at 51.43 today. So NASDAQ has been making me nervous on this run, and I think this is still a strong stock. I mean, it's done everything right as far as earnings go and positive earnings. Customers ask me, well, are you going to roll the put down? Are you going to make another adjustment on the radioactive trade you have open in the Fusion subscription at Radioactive Trading? And right now I'm not, because I'm so hedged out with the 60 put, is that I don't see reasonable logic to roll it down and take the risk to 10% by dropping down to 50, from taking the 60 strike down to the 50. I was going to roll down to the 55 when it was at 54, and I hesitated, and I'm glad I did, because now it's back down to 51. So I'm going to wait a little bit on this one. Might be able to do that also as well. Okay, now, this is a question that, okay, yeah, so Larry's in the 4 days. Now, Todd, so it's Ted, jeez, sorry, Ted. Ted makes a comment, and I agree with this comment, which is why I have so many webinars on them, but let me show you something else here. Now, I don't know his numbers, okay, and Larry's sharing his Iron Condor, weekly Iron Condor strategy with us out of the kindness of his heart. He didn't give us specifics, he just told us what he's been doing. And in the Bull Put Credit Spread webinar, or the Credit Spread webinar series we did in August, and then in some follow-ups we've done to that as well, we've talked about why we set up the default weekly Bull Put Credit Spread criteria the way that we did, and what were the outcomes of it. Now this leads to Ted's question, and Ted says, when evaluating the merits of any particular strategy, shouldn't you include the adjustments to that strategy the one would make if it or one of the legs in the case of a spread? So if it got threatened one way or the other in case of spread. He says, I listened to a presentation recently where the guy said he commonly makes more profit when a trade goes bad, and he adjusts it than he would have had his original expectations been realized. To answer your question, number one, Ted, yes. In all of our webinars that I discuss for trade management under our options strategy section, managing your spreads, managing your naked put positions, managing covered calls, we walk through these 6 or 7 ways that you can use to manage a spread without overly making it complicated. Going back to what I talked about previously in today's presentation, we were talking about that Bull Call Debit Spread and what you might look to adjust it to make it more profitable. And we saw 2 particular adjustments that would increase the potential return. That one's going with us. But we do it in a way that keeps it simple. And what do I mean by that, Ted? When I talk about managing a spread, a bull put credit spread or a bear call credit spread, that webinar and all the webinars about managing strategy techniques, we discuss the pros and the cons of the simplest adjustments, or what I should say the most common. Rolling the spread down and out, converting a bull spread to a bear spread based on your expectations, or converting a bull put spread to just a long option, okay? As I mentioned, what I don't touch upon, Ted, are these ideas if a bull put spread starts to go against me, adding 2 to 3 options to create a butterfly, which I don't think would increase the return at all, or some kind of ratio debit or ratio credit put spread where the risk is actually increased. The management techniques I discussed are designed to not increase the risk if the stock rebounds or recovers in the opposite direction. Okay? Now, let's take AMAT. Let me go back here. And I want to go here. Now I'm going to go here. I'm going to go to the 21st or 22nd of November on AMAT. Okay? Let's go back to our chain. Let's go to AMAT. Okay? And I'm going to go to November 22nd or 24th, somewhere in that time frame. Let's try the 24th, okay? And AMAT was at 57.91. All right. I will look at December 15th. I'm going to go to puts. I'm going to do a bull put credit spread, Ted. All right. So I'm going to look standardly, just selling at this time. When the stock was at 57.91, it had pulled back from its earnings. But I'm going to buy a 55. So I'm sorry, Ted. I'm going to sell a 55. We're going to call it 50 cents. December 55 at 50 on November 22nd. November 24th. Let me just go to the medium chain. It didn't give me the 50. Let's be nice to ourselves. Let's call that 10 cents. Okay? Really be probably 9 cents. We'll call it 10. So that's going to be our bull put for December 15th expiration. Okay? All right. Okay, it was an options animal presentation. Okay. That's fine. I'm not... He puts out options animal puts out a lot of information. And I think I actually know the webinar you're talking about. I know he didn't. You know how it is in any industry, Ted. I saw an advertisement from Options Animal, and believe me, no, I like his ideas in the sense that I like that he's educating and he's putting out a lot of information. However, I have noticed that during a given trading week, I may see 5 or 6 emails from Options Animal that are covering 4 different strategies and 5 different topics. So pick and choose which one works best for you. All right? They don't stay with a standard methodology and approach, it seems. They have good ideas. They're great educators. They're very knowledgeable, don't get me wrong. But sometimes I fear they're putting out too much information on too many different ideas and concepts at once where it's hard for an individual investor to digest them. Okay? As I mentioned, of course, you know, there's one of the things that I said earlier in the presentation is that if you mention a strategy or mention an approach, oh, sorry there, we're adding in our bull put spread here, that I might need to clarify it. And the reason why, again, is that I saw recent webinars done where experts are calling a strategy something, and it's not what I'd expect. When you say synthetic covered call, I think you're doing a synthetic long stock and selling a call. They were calling a naked put trade with an extra put below it to cut down the margin, which to me is a bull put credit spread. They're calling that a synthetic covered call. That's a parity trade to me, but it's not a parity trade because you just did a bull put spread. Similar to this. This is a bull put spread. I would never call this a synthetic covered call. They did it this way to free up margin. So instead of buying the stock and selling a call and using 20% margin, if you sell the same naked put, but buy a lower strike put, it's almost the same as doing a covered call with 20% margin. I just call a bull put spread a bull put spread. I don't give it another name. That's me personally. And again, to me, a synthetic covered call would be selling a put, buying a call at the same strike and same expiration, and then selling the call you would have sold for the covered call position, whether it's out of the money, in the money, or maybe even at the money. That to me is synthetic. You did a synthetic long stock and sold a call against it. Or you're going to ask me about a jade lizard or a big jade lizard or a small jade lizard with a calendar twist. I have no idea what that is. I have to Google it to show what that is. But in any case, all right. Here's our position. We know it's going very far against us, all right? Now, Options Animal says that they manage losing trades and they'll receive more money. The original expected return on this, oh, shoot. That's why it looks so awkward. My apologies, 50 and 10. All right, so here's my original position. Sorry, folks. There we go. There's my original position. 8.7%, 40 cents on a 5-point spread. Good probability at the time, but now it's totally gone against us. And it's really a 10-to-1 risk-reward ratio. I probably wouldn't have ventured this. And Larry, thank you for your comment there. I'll get to that in just one second. But here's a bull put credit spread that's gone against us. Why am I showing it this way? Hindsight 2020, I could have tripled, quadrupled, maybe even more the original return I expected. Remember, I sold the 55 right here. So if this happened in the beginning of the day, by the way, it sort of bounced down and then came back up. But let's say right here on November 28th, something was bothering me. I was worried about it. I tried to get in when it was 61. It came back up, and I decided, okay, right here on the 22nd, it looked good, but it pulled back, and I said, oh, this is worrying me a little bit. You know what? Let me go back. Oh, sorry. Let me go back to the chain on AMAT to the 28th. Okay. And at this time, I decided something wasn't right. I didn't like the way that AMAT was bouncing around. So I should have gone to just the puts. Let's go back to just the puts. And let me clear out my drawing, folks. I apologize for that. There we go. And at this time, all right, the 55 call, I decided to buy back for, let's call it 49 cents. Okay, so I took in 50. I'm going to buy it back for 49, meaning I'm only going to keep 1 cent profit, which means I now have a long put, the 50 strike, for 9 cents. That's one of the 7 ways I might manage it. If my sentiment has changed, I might buy to close the short option and leave the long open. Okay? Well, right now, that's worth 36 cents, 39 cents. So I sell to close it, I make 30 cents, not as much as I originally expected. Okay? But had I done this, had I bought back the short call November 28th, and then on December 1st, remember, what am I doing now? I'm just holding the 50 strike put. It's up at, let's call it 70 cents. Okay, so instead of the original return of 40 cents, I could have made about 61, 70%, 33% higher than I originally anticipated. I could have done something also confusing at that point. Rather than buying to close the short put on the bull put spread, I could have bought an extra put at the 52.5 strike, which might have been cheap, but as the stock fell, it would have increased the return. Okay, would have done better. But now I've got something that's really not a name. It doesn't really have that good of a name. Yeah, and so if it goes bad, buy another put. Okay, it's an interesting problem, Ted, and you're right. Let me go back to my original position. I enter a bull put or a bear call or anything along those lines. Okay, let's sell this again for our 50 cents. All right. The stock pulls against me as we saw AMAT did, even at this point. So if it dropped to 52 here, okay, so when the stock broke down on this day, remember we're holding the 55 put that we sold. We own the 50 here. Stock breached here, and let's say we buy the 52.50 put. Well, when the stock hit this point, we could have made more profit. Stock came up here again yesterday. We're now losing money on that 52.5 put. You'll see this in my other webinars. What I'm saying is that, yes, he's absolutely correct. If your sentiment, there's two ways to look at it. Here we are in a bull put credit spread where we need the stock to stay above 55. I have mental stops in place and stops in place, so when that gets breached, when my exit is hit, I'm going to look to manage it. Am I just going to roll the short put down? Am I going to move the whole spread out in time to lower strike prices? Am I going to buy an extra put? But remember, even if I buy an extra put, Ted, I still have, this is one of the reasons why I don't like changing, as I mentioned before, and I may sound boring in this regards. I may sound too conservative. But look, when the stock starts to reach this point, what do I have here? I have a short put. What does the short put do? Regardless if it's in a spread, part of a spread, covered by two puts at different strike prices that are purchased, this is still an obligation to potentially be forced to buy shares of stock at 55. Owning a put at a lower strike does not change this obligation. It just means that you have the right to get someone to buy it from you so you can't lose more than this amount. When the stock breached down to 53, if I bought a 52.5 put and made this sort of a, kind of ratio back spread, in a sense, where I have a smaller credit, in fact, or maybe a loss up front, but now unlimited downside protection, if the stock continues down to 35, 40, 45, this looks great. If it comes down here and then moves back up, I'm probably losing more here. Look at where the stock is right now. It's at 51.43. Let's say I had bought that additional 52.5 put when the stock was falling for 70 cents. Let's add it in. So when the stock was at, I'll even be nice, I'll say 30 cents. So we still keep a credit, which is unlikely in this case because of the amount that it dropped. All right. There's our sort of Big Dipper ratio back spread position. I realize this is a Big Dipper profit and loss chart. Now I can still make $10 if the stock recovers and goes above 55. Max loss is 240. Less than what we originally started with. I'll give it that. Max profit is infinite, or to $4,760, effectively the break even. Okay, might have even be able to buy a 55. No, you can't buy a 55. What am I saying? All right, so this is a repair, and you're right. Will it outpace the maximum gain? If the stock continues to rocket downwards to no avail, absolutely. Stock comes back up and recovers here. Is this a better position to be in than having bought to close this early enough to maybe close it for a profit and just left the long open? We had a lower break even. Now you only have 2 legs instead of 3. What's the other advantage of just buying to close the short if you catch it fast enough? That is a caveat of what I'm saying. Okay. Now, here in the situation, if the stock's trading in this area, where am I still at? I may still end up buying shares of stock at 55 because if it goes back to 53 or 54, this is still in the money and I still have to pay $2 or $3 to buy it back. Plus I lost money on this put I bought. This was already accounted for in the original bull put spread. So that's why it's still a loss here. But remember, if it's in between, you still have an obligation to potentially buy shares of stock at 55. That doesn't end. And this doesn't help it. This only helps if the stock continues to move down. In which case, why leave that potential obligation open at all? Why not just close that, not worry about buying the extra, leave the initial open if you're expecting that big of a fall. And you mentioned that you'd look to buy an in the money rather than the out of the money. Okay. And I'm on December 1st when it's at 51.90. Now let's go, let's go back to November 30th. One more day ahead. Let's go back to November 30th. Okay. And so in this case, when the stock had breached our short strike at 52, I want it to be higher. I know I'm cherry picking, but I want it to be higher. Now it's got to be there. I know we wouldn't have done this, but this wasn't earnings related, by the way. This drop was not earnings related. This was the NASDAQ day. All right, so the stock fell to 52.91, breached my short put strike on November 29th. It's right between my two strike prices, my 55 and my 50. So we have the 55 put that we sold. We're going to buy a 56 put at, let's call it 350. All right, 56 put at 350. Still going to give us a similar profit and loss chart, a little bit different, subtly different. In the money, 350. 40-cent net credit on the original bull put. There we go here. No. Break even's a little higher at 47.90. So now if it goes down here, it could make more profit, but no. Loss is still at 208 in the middle, same thing where it was. Yeah, I'm not. And I know what you've got now. Yes, you've got probably need to be more strikes wider, but you have a bear put debit with a bull put credit, and it sort of gives you this. Short could be profitable if it drops below 47.90. 47.90, remember that. So it broke through. I would have bought the in the money strike here, gone at that price. 56 when the stock's at 52.90. Yeah, I could have bought the 54, the 53, but when you said in the money, I assumed it meant in the money above the original put strike you purchased. It's at 350. Out of money requirement 810. Max risk is only 310. Okay, but remember we opened a 5-point spread with a 40 cents, so our original max risk was 360. This does lower the max risk. That's a good benefit. But the break even's 47.90. Okay, so you start making a profit. If it goes to 45, you'll make $2 on the position, well above the 40 cents, 5 times above the 40 cents you expected to make. I agree with that, if it keeps dropping. But remember what I saw. It breached here. We closed this for 49 cents roughly at midpoint when it started to get close to the put strike price, which meant we owned a 50 at only 0.9. All right. Break even is at 49.91. The break even of the in the money put combination we just showed, or that big dipper handle, was at about 47.90. What happens if I caught it close enough, bought to close the short, left the long option? Not dealing with 3 legs options trade now, just dealing with one. It's now a long put. If the stock went to 47.90, I've made $2 already. Where I'm breaking even on the in the money repair with the 56 put. And I'm still just about at break even if I bought the 52.5 put when the stock started to go below 55, my short put strike price. And I have no obligation to be forced to buy shares of stock or be assigned early because I own just a long put. One contract to follow, one break even. If we're still bearish and it drops down to 47.90, we've made $2 on this, 5 times above the 40 cents we expected to make on the position. That's what I mean, Ted, by keeping it simple. Not having a 3-leg or 4-leg working position, trying to figure out what your obligations and your risks are, what you have to cover on the position. But all of this is speculative. And this is not to downplay what Options Animal is doing. I know I kind of sound like I'm doing that. But it's all dependent on catching it at the right time. It's all based on timing. Knowing that if I had been in that bull put with the 55.50 strike when the stock reached within 1 or 1.5% to 55.50 or so of my short put strike price, I would have looked at one of those 4 ways to manage the position based on my sentiment now going forward. I would have been harder pressed to do that because this fell so quickly on that day with that NASDAQ decline at the open, it breached through 55. So I would have had to buy the short putback when the stock was maybe at 54.70, I think, 54.40 is a price I saw it at when it first opened. So it would have cost me almost $1. But still, that would have only added 50 cents to my cost basis. So it would have been a call at 50 for 60. Break even still would have been 49.40. Just makes sense to me. It's easier to follow instead of trying to put in these ratio combinations and have 3 or 4 working legs to repair a credit spread when you could just roll the spread down if you still had a bullish sentiment and thought it was just a simple correction, or you could just close one leg, leave a long option open, have the same infinite risk with a much lower break even. What is the risk of this position now? Well, the risk is the stock goes back up and I lose the full $9. So I'm quite okay with that in those situations, but it's dependent on catching it at the right time. And you're not always going to do that. With what we saw on the NASDAQ, which even Larry mentions that with his 155 weeks of only having one loss with these Iron Condor positions, the NASDAQ is scaring him. On an offshoot, what Larry's saying is that based on his studies, what he's been doing for the last 150 weeks, the criteria is based on the price of the index, the highest VIX or IV, the number of days to expiration, and they use the standard deviation of 1.75 or 1.5. So the legs of that Iron Condor we were talking about, that's only 4 days out in time, and he never stays in positions over the weekend. I don't stay in any spreads over the weekend usually either, with the exception of my Bull Put weekly spreads there. But that's sort of the criteria that you've been looking at for your Iron Condors. You focus on the price of the volatility, the VIX, the price of the index itself, days to expiration, you're keeping under 4 or 5, you're never in it over the weekend, and you use a 1.5 and 1.75 standard deviation. The probability we show on Power Options, by the way, is based on a 1 standard deviation of the past 52-week trading range of the stock indexes or ETFs as well. Yeah, so Larry's had fantastic success with the Iron Condors. Last week or 2 weeks ago, I think it was 2 weeks ago, we reviewed the track record for the Bull Put credit spreads, where we're at a 94% success rate and only 6 trades out of 256 for that 28 or 29 month period. We're losers. Only 6 were losers. No, it was less than that, wasn't it? It was a 96% success rate. I'm sorry. I got it right here in front of me. My apologies. 95% success rate out of 173 total trades made from May 2015 to November 2017, 30 months. So it's 95% success rate and the 79.7% return over that time period. So that's what we were talking about with the Bull Put spreads. And going back to what was mentioned earlier, we mentioned that why don't you discuss the management techniques? We do in those other webinars, but actually for the Bull Put spread testing, you've heard me mention about that 2-week testing with the bear calls and the other historical testing we've been doing in the background. For that Bull Put spread, I don't manage the losers. And the reason why is because it's at a 95% success rate. Only 9 trades out of 173 were losses. Just accept the loss with that kind of ratio and move on. In reality, what that means is I haven't had the time to go back through and show you how I would have managed each of the 9 trades over that 30-month period. But that's just what we're looking. When you have a success rate that's high, sometimes you're okay. When you've seen it over 30 months and tested it, you say, okay, I'm just going to accept the loss, whether it's a 20, 60, or 80% loss in the Bull Put spread. And if it's at a 95% success rate, I'm okay necessarily not managing it. Just take the loss, move on. Don't make it more complicated. And in my opinion, simplicity is sometimes best. I know that sounds strange to hear from someone who basically spends an hour and a half every Friday delving into these positions and probably over talking and not making it very simple for some of the strategies we discuss. But at the same time, I get nervous when I see education out there about managing a Bull Put spread by creating an Iron Condor, by creating a ratio butterfly. I just have to stop and think and say, what is the complication? How many more options are you getting into? How bad is your risk increasing if the stock does X or Y? And if your direction is you're trying to do this to get an infinite profit to one direction or the other, why not just flip the trade by closing one option or rolling one option and closing the other, and then you're set, okay? All right. Larry says, why do folks do all of that stuff? Honestly, it's new. It's sexy, I guess. I mean, think about it. I was actually intrigued. I saw that same email we were talking about with, I apologize, the same email we were talking about with Ted from Options Animal. Don't get me wrong, they give great education. But his title for the email that I saw 2 weeks ago was 6 ways to manage your credit spreads. And when I saw that, I just had to register for the webinar because mine from August, managing your spread positions, was our preferred 7 ways to manage credit or debit spreads. No, he's not copying from me at all. I'm not saying that at all. But it kind of made me laugh that the numbers were about the same. We probably discussed 80% of the same material, and he probably never even watched my presentation. That's fine, I know, because there are several common ways that you would adjust a position first. But again, the reason why is that it does sound sexy. If you tell someone you've got a new way to manage a spread that will increase your profits 5-fold of what you originally expected to make when it moved in the wrong direction, yes, that's possible. If and only if X happens, and most of the investors who are attending that presentation are having enough problems understanding the complexities of a credit spread portfolio to begin with, that they don't need to be overly confused by converting a 2-leg spread that they're just trying to learn and manage into a 3-leg, 4-leg, or even 5-leg butterfly, ratio butterfly, or condor, where they don't even know anymore what the risks and obligations they have on the table and the margin requirements for their brokers. I like to take it slow. I like to take it simple. Those kind of management techniques have their place. I agree, especially for investors who are more active in doing weekly options where almost every penny counts. Larry, you can appreciate that. You probably hate to see a loss when you see a loss in your spread, which is, by the way, is one of the same reasons that if I open an Iron Condor, I'm only opening it on a broad-based index or ETF. I don't trust myself, and I don't trust the market enough to do Iron Condors on Google, Priceline, Apple, not even Apple, but Netflix or anything like that. It's only going to be broad-based indexes and ETFs that I'll do Iron Condors on. I just haven't felt comfortable doing it, and congratulations, that is amazing. Your success rate's amazing, and you're doing extraordinarily well. That sounds fantastic. Really good job, and I'm glad it's working out for you. Just got to beware when the market corrects itself, but again, these same ideas, though, some of these techniques here about managing your bull put spreads, your bear call spreads, also can be done inside the Iron Condor. If I'm in an Iron Condor and the stock starts to move against the lower side, I'll manage just that lower side as I would a bull put, just leave the bear call open, go from there. All right, ladies and gentlemen, that looks like it's all the questions that I have for today that have come in. Oh, thank you all for an amazing discussion today. I do want to remind everyone, I always have to do this, no, I have never gotten in, I want to say I've never gotten in trouble for this or anything like that, but I always just want to make sure that everyone's aware of one thing and one thing only, and that, of course, is that today's material are just my thoughts on your question, designed for educational purpose, increase investing performance, and options knowledge. Any of the stocks or options discussed today should not be taken as direct trading suggestions. I am not recommending trading AKS the way that we showed with Rajiv's position. Not recommending getting into AMAT, Applied Materials, right now, even as a married put, which is how I started the trade with limited risk. You want to do your own research and analysis, okay? Yeah, options involve risk, may not be suitable for all investors, and that's why we spend a lot of time talking about everything that we did to make sure that everyone has their risks covered, knows about the obligations, and more, okay? All right, so just remember, everyone, if you haven't tested Power Options yet, remember, go to powerop.com. You can just put in your name and email address, and you'll have access to a full 14-day free trial to Power Options, all the tools we showed today, plus many more. The monthly subscription levels at Power Options start at $40 per month for the end-of-day service. We do offer a 20-minute delayed service at $60 per month. Real-time service is also available. And full back testing, upgrades from the delayed service and the real-time. I just showed today some of how you could use the historical tools for analyzing the chain. but there's a full back test for the search, so you can search your criteria over time. And if you subscribe to one of the historical services, as you saw today on the chain, I only went back about 2 or 3 months. Only 2 or 3 months were available to me. On our historical service, the data goes back to April of 2006. So you have 11 years of data that you can run historical searches, historical testing, look at the portfolio, the option chain historically, and more as well. All right. So just remember, everyone, you can check out other free information, the blog.powerop.com at any time. You can go to that webinar page. We referenced it 2 or 3 times today. It's powerop.com/webinars.asp. And you can always take a look at our YouTube channel as well. Just go to YouTube, look for Power Options, all one word. Most of everything that you'll see on the webinars archive page is also on YouTube. There's a lot more videos floating around there on YouTube from years past. This was mentioned earlier with the Iron Condors and more. If you think of any questions later on you didn't get to ask today, or any comments or further discussion, remember, send me an email at any time, support@powerop.com. You can also ask radioactive questions to me at support@radioactivetrading.com. We're available during market hours. You can always call us during the office, at the office during market hours at 302-992-7971. Remember, trial members and subscribers, you can schedule one of those coaching sessions at any time. That's essentially a 45 to 50-minute phone conversation with myself or Ernie, one-on-one, walk you through the tools on the site, answer any questions that you have. And of course, if you want for your coaching session, we can set it up sort of as a screen sharing, go-to-meeting, go-to-webinar platform like we're looking at today, where we can show each other screens if you feel that helps you as well. All right, ladies and gentlemen, have a fantastic weekend. Going into standard December expiration next week, the last of 3 expirations for 2017. I'm not including the Monday and Wednesday options that are for SPX and those ones that now offer 3 cycles per week, but just the Fridays, 3 full Fridays left of expiration for 2017 before we get into the next year. So we'll be back again next Friday for expiration. You'll see some other emails for us coming soon. Once more, thank you all again for your great discussion today. Thank you for your great questions. I hope everyone got some useful information. Mark says, thanks for walking around your website showing how to do some of the back testing and analysis on particular trades. Mark, you're welcome. I hope you got some useful information out of it. And Larry says he enjoyed very much. He always learns something. I'm glad to hear that, Larry. Thank you for